Welcome back to the Deep Dive. Today we're diving into a fascinating trading strategy that really cuts through the usual market chatter.
Yes, it aims to simplify how you enter a trade and, crucially, how you manage your risks.
It's an approach that feels both systematic and, surprisingly intuitive.
Our goal for this deep dive is to really dig into the pullback trading strategy. We'll explore how it's designed to help traders spot those opportune moments.
And we're drawing from an expert article, right? One that breaks it all down.
Exactly. It breaks down the system from A to Z and even gives us a step-by-step example using the gold market, which is quite helpful.
Okay, so if you've ever wondered how to pinpoint market entry or, manage your risks effectively, maybe calculate optimal position sizes,
Then you're definitely in the right place.
we're going to try and give you a shortcut to understanding these crucial elements, making what might seem like complex financial jargon surprisingly clear. Hopefully.
We'll look specifically at determining that market entry point, setting stop-loss orders, which is vital for protecting capital-defining profit targets.
Implementing risk management, calculating position size, the whole package.
Right. And what's really fascinating here, I think, is the universal applicability of these methods. They go way beyond just the gold example we'll look at.
Okay, let's unpack this then. At its heart, what exactly is this pullback trading strategy all about? What's the core idea?
Well, the core idea is to find a moment when the market has already, established a clear trend.
Yeah.
It's broken through a resistance level.
Arc ceiling, yeah.
Precisely. Then it temporarily pulls back or dips down to that level it just broke.
Ah, okay. It revisits it.
Yes. Before hopefully continuing in its original trend direction, this pullback signal suggests the little correction might be ending.
And that's your entry point.
That's potentially an ideal entry point, right as the next impulsive wave of movement might begin.
So it's like catching the trend right as it restarts after a brief pause, like it takes a breath.
Exactly like that. A strategic pause.
But is there a risk there? I mean, could you miss the initial big move by waiting? Or maybe mistake a real reversal for just a pullback?
That's a very good point, and it gets to the nuance. The article actually highlights that one advantage is how quickly you often get the result.
Oh, how so?
Well, the market either moves pretty much immediately with the trend, confirming your entry, or it reverses quite decisively.
Meaning it breaks that nearby level.
Yes, and that signals you to get out with a limited loss.
Yeah.
So the speed of resolution kind of acts as a built-in risk manager, reducing that uncertainty.
That's a great image, like a spring loading up. You wait for that compression to get in, anticipating the release. And like any opportunity, timing is key. So when do these moments tend to happen? Are there specific times to watch out for?
According to the source material, yes. January and early September are mentioned as key periods.
Why then specifically?
Well, that's typically when the major players think institutional investors, big banks, hedge funds, return to the market after a bit of a lull, like holidays or summer breaks.
Ah, okay. They come back looking for opportunities.
Exactly. They're seeking thriving assets, looking to position themselves. And this influx of activity often leads to strong market movements and the formation of these attractive medium-term trends.
And this is where having a concrete example really helps, I think. The article uses gold in 2016.
It does. Let's dive into that practical application. It uses the spot gold market on January 14th, 2016.
Okay, what happened? What was the signal?
The signal was pretty textbook. Gold had broken through a resistance level, a price ceiling it couldn't get past before. Then it came back down right to the upper edge of that broken level
Adjusted it.
and bounced off it decisively. That was the classic pullback signal we were just talking about.
And the entry point they identified.
The article states the entry point was $1,093 per troy ounce.
Okay, so that gives you a clear starting line. But as you said, not every trade works out. What about protecting yourself? The escape route.
Exactly. That brings us to, a foundational question. Managing risk effectively.
The stop loss.
Right. When you open a buy position like this, the strategy says you place a stop-loss order strategically around the nearest support level. That's your predefined exit if the market turns against you.
It's like knowing where the fire escape is before you enter the building. It must reduce stress, right? Having that defined beforehand.
It absolutely does. Your maximum potential loss before the trade even really gets going.
So in the gold example, where did they put it?
Okay, so for that gold trade, the nearest support level on the daily chart was around the lows formed back in late December 2015. So the suggested stop-loss order was placed at $1,057 per troy ounce, just a bit below that support zone.
Just underneath it.
Yeah. Now, the article does mention, more advanced traders might use something called an ATR indicator.
Average true range. Measures volatility.
Exactly, to fine-tune it. But for understanding the core idea today, the key is anchoring that stop loss to a significant support level, like the $10.57 here. It gives you an objective line.
Okay, so you have your entry at $10.93, your stop loss at $157. How do you translate that into actual risk? Because money and points aren't always the same thing in trading, are they?
They aren't, and that conversion is crucial. So first, you calculate the distance between the entry price and the stop loss price.
$10.93 minus $57, that's $36.
Right, $36 per ounce risk in monetary terms. Then you convert it into points. In the spot gold market, the article notes 1 point is 0.01 cents, 1 cent.
Okay.
So you divide that $36 risk by 0.01 cents per point.
And you get 3,600 points.
Precisely. 3,600 points of risk. And understanding how we get this number, quantifying the potential loss in these standard units, is vital. It directly feeds into calculating your position size and checking that risk-reward ratio.
Got it. So just like support levels help with stop losses, those old price ceilings, the resistance levels, help define profit targets.
Exactly. Those resistance levels are often where trends tend to stall or even reverse.
Why is that? Just market memory.
Partly market memory, partly because a significant number of traders react to them. They might take profits there, or even initiate trades in the opposite direction.
So it's almost a self-fulfilling prophecy then. People believe the levels matter, so their actions make them matter.
It certainly has that element. It's a powerful psychological aspect of the market, absolutely.
Yeah.
And the reliability tends to increase with the time frame.
Meaning a weekly resistance level is generally stronger than a daily one.
Generally, yes.
Yeah.
So the article suggests that while you might find your nearest targets on the same time frame as your entry, say the daily chart, for more optimistic but still objective targets, especially when you catch a new trend early, you might look at a higher time frame, like the weekly chart.
Okay, so for the gold example, entering on the daily chart in January, what time frame did they use for the target?
Since the entry was daily, and January is often a strong period after consolidation, they looked to the weekly time frame for a more ambitious target.
And where did they set it?
The target was set at $1,177 per troy ounce. That was just under the lower border of a significant weekly resistance zone identified on the chart.
Aiming to get out just before hitting major potential trouble.
Exactly. You capitalize on the trend, but respect those established levels.
And the potential profit and points there.
Well, the potential profit was $1,177 minus the 23.3R entry, which is $84 per ounce.
Okay, and converting that to points, $84 divided by 0 to 1s.
Gives you 8,400 points of potential profit.
Right, so 3,600 points of risk, 8,400 points of potential reward.
And that leads us straight into what the article calls the absolute cornerstone of professional trading.
Which is?
Potential profit must exceed potential risk by at least a factor of 2. That 2.1 risk-reward ratio, it's fundamental, non-negotiable, really.
Why is that 2-to-1 ratio so incredibly important? It sounds simple, but you're stressing it's profound.
It really is. I mean, imagine two traders. One wins, say, 60% of their trades, but their average win is only just a bit bigger than their average loss.
Okay. Winning more often than not.
Right. The other trader wins only 40% of the time, less often. But every time they win, it brings in at least twice what a losing trade cost them.
Ah, I see.
The second trader, despite winning less often, is actually building capital much faster and probably with far less psychological stress.
Because they don't need to be right constantly.
Exactly. That's the power of the 2.1 rule. It frees you from that immense pressure of needing to win most trades. Without it, trading could feel like a high-stress guessing game.
So how did our gold trade example stack up against this vital metric? Was it a go?
Oh, absolutely. We had 8,400 points potential profit, 3,600 points potential risk.
So 8,400 divided by 3,600.
Gives us about 2.3.
Which is better than 2.1.
Clearly exceeds the minimum 2.1 rule. That makes the trade attractive from a disciplined risk management perspective. This is the kind of objective check that removes emotion and enforces discipline.
Okay, this is clicking into place. We know the entry, the stop, the target, the risk reward is good. Now the big one. How much money do you actually put into this trade? How much capital?
Right. And it's definitely not a one-size-fits-all answer. That's where optimal position sizing comes in.
And you said earlier it's dynamic.
It absolutely is. It's a dynamic calculation. The size of your position should actually change with every single trade.
Really? Why?
Because it adapts precisely to the size of your stop loss in points for that specific trade.
Right.
The risk in points we calculated earlier, that 3,600, That dictates the position size.
Okay, that's critical. It's not just a fixed amount per trade.
No, not if you're managing money professionally. This principle is often what separates consistently profitable traders from those who struggle. Seems counterintuitive, maybe.
How so?
To make money, you first have to focus intensely on not losing too much money on any single trade.
So how does this dynamic sizing help a trader long term? What's the real benefit?
Well, this approach maximizes the profit you get from your winning trades because your size is appropriate for the risk. But crucially, it also makes it very, very difficult. The article actually says a challenge.
A challenge to lose money.
A challenge to wipe out your account during a losing streak. Because each loss is contained. It's a controlled percentage of your capital, regardless of how many points were risked on that specific trade setup. It's the key to long-term survival.
And there's a formula for this. It's not just guesswork.
Yes, definitely a formula. Let's stick with the article's example capital of $5,400.
Okay.
First, you decide your risk percentage per trade. Maybe 2% for conservative, 3-5% for moderate, 5% or more if you're aggressive.
Let's use 2% like the article suggests.
Okay, so 2% of $5,400 is 108 That's the maximum dollar amount you're willing to risk on this single trade.
Got it. 108 max loss.
Then we need the cost of 1 point for one standard contract. For gold, the article states this is $1 per point.
Right. And we know the risk for this trade was 3,600 points.
Exactly. So now we plug it all in. The optimal position size is your capital, your desired risk percent. Risk in points for the trade cost per point per contract.
Okay, so 5,400.02, 3,600 points.
What is 108 points divided by 3,600?
Which equals 0.03.
0.03 of a standard contract. That's your optimal position size for this specific trade setup, given your capital and risk tolerance.
Wow, that is incredibly specific 0.03 contracts.
And critically important.
Right.
In the spot gold market and many others, you can often trade fractional contracts, like 0.03. This allows for that precise risk management.
What if the number came out smaller, like less than the minimum trade size?
Good question. The article notes if the calculation resulted in, say, less than 0.01, which is often the minimum, you couldn't actually take the trade with your desired low risk level.
So what then?
Well, it might mean the risk in points for that setup is just too large for your capital base, or your capital is too small. You might have to look for a similar instrument with a smaller contract size, maybe mini contracts or micro contract, or
Just skip the trade.
just skip the trade. Protecting capital is paramount. Or, as the article mentions, you could explore options trading, which offers different leverage and risk dynamics.
Okay, so pulling back from the specific gold example, what are the big universal takeaways here? What makes these ideas so broadly applicable?
The core principles really are universal. Determining entry based on pullbacks to broken levels, calculating your risk in points, demanding that 2.1 reward-to-risk ratio, and especially calculating position size dynamically based on risk.
These apply everywhere.
They apply across different trading styles, short-term, medium, long-term, and across all sorts of actively traded markets, currencies, commodities, stocks, indices. The principles remain the same.
And that gold trade itself, did it work out beyond the initial target?
Interestingly, yes. The article notes the price actually moved well beyond that $1,177 target. It eventually reversed around a monthly resistance level, way up at $1,282. Shows the potential power of catching a trend early.
Wow. And they mentioned an alternative way to play it too, right? Not just buying gold directly.
Yes, they did touch on using the options market as an alternative.
How would that have worked?
Instead of buying gold, you could have bought a February call option on GLD. GLD is the big gold ETF, tracks the price.
Right.
And in that specific case, buying that call option apparently offered an even better potential risk-reward ratio, something like 1-4.
Interesting. So different tools for the same basic idea.
Exactly. It highlights how different instruments can express the same market view, but maybe with different leverage or risk profiles.
It's also telling what the article didn't cover, isn't it? It hints that this strategy is just one piece of the puzzle.
Absolutely. It explicitly stated it wasn't going into how to determine the overall trend direction or how to analyze the general market conditions.
Which are obviously crucial.
Foundational, yes.
Yeah.
It emphasizes that while this pullback strategy gives you a detailed framework for execution, when to get in, where to put stops, how much to risk it needs to fit within a larger trading plan, that includes that broader market analysis.
So that raises a question for our listeners, really. How do these universal principles, the disciplined entry, the risk management, the position sizing, how do they integrate into your broader understanding of the markets and your own financial decision-making? Wow, that really was a deep dive. From spotting those entry points after a pullback, to setting stops, targeting profits, and calculating that precise trade size, we covered a lot.
Dude.
Hopefully you listening have a clear picture now of how a systematic, rule-based approach can, take some of the mystery out of the markets, make decisions more manageable.
Definitely. We've seen how a structured method, really focusing on those defined rules for risk and reward before you even place a trade, can provide a significant edge.
It's about making informed decisions, right? Based on objective criteria, not just gut feelings or emotions.
Precisely. That discipline is so key. It helps you weather the inevitable ups and downs much more effectively.
So what does this mean for you, maybe beyond just trading, next time you hear about market moves or you're considering any kind of investment?
Perhaps you'll start looking for those pullback moments, those retests of levels.
Or maybe just instinctively consider how that 2.1 risk-reward ratio could shape your decisions, making them more robust, perhaps.
Yeah, think about how these universal principles, managing risk, sizing your commitment based on potential downside, could apply more broadly.
Not just trading.
Not just trading. Any decision involving calculated risk, really. A business venture, a career change, even a personal project. Defining your acceptable loss and your potential gain beforehand. It offers a really powerful framework.
Makes for more confident, strategic choices all around.
I believe so.
Well, thank you for joining us on this deep dive. Until next time, keep learning and keep exploring.